Hi, folks. Today is January 14, 2022. My question for you is, have you ever wondered about anything out there? What is out there to benefit you in terms of planning for your retirement plan? What if there was something out there that you were not aware of? Wouldn't it be good to know about it just in case it might benefit you? So maybe there is something that you're not taking advantage of. Have you heard of the late Senator William Roth from Delaware? He felt that Americans were paying too much in taxes. And so he created the Roth IRA back in 1998. Up until then, we had something called a traditional IRA. So what are the differences between a traditional IRA and a Roth IRA? So let me backtrack. Let me explain what a traditional IRA is. With a traditional IRA, you make your annual contribution and you get to deduct that from your income tax return. So it ultimately lowers your tax base for that particular year. But what you're doing, in effect, is you are deferring the taxation of that contribution into the future. Is that good? Is it bad? Is there something maybe better? Well, let's talk about what we're doing. If we're making, let's say, a $6,000 contribution into the traditional IRA, and we do so every year going forward, do you think that that initial $6,000 contribution that you made will grow over time? Absolutely, that's the goal, isn't it? We want our money to grow. We definitely want our money to grow for our future retirement. So if you're making a $6,000 contribution, and let's say that $6,000 grows to, I don't know, let's just say 100,000. I like to use easy round numbers. So you're delaying paying the taxation on that $6,000. Now, when you retire with your traditional IRA, eventually you'll have to start to take money out of it, and the government imposes what is called required minimum distributions. It used to be at age 70 and a half, but they moved that to age 72. So at age 72, whether you want to take a distribution or not from your traditional IRA, you must. And if you don't, you'll get hit with a huge penalty. How big of a penalty? 50%. A lot of times people do not want to take money out of their IRAs because they just don't need it and they want to leave it to their heirs. But with a traditional, you must take your required minimum distributions. Now, with the Roth IRA, you do not get to deduct the contribution off your tax return. Think of it as after-tax dollars going into your Roth IRA. So you've already paid taxes on that money. And here's the benefit. As that money grows, that $6,000 contribution, as it grows to 100,000 or whatever it may be, I just like to use 100,000 as an example, you will never ever have to pay taxes on your Roth IRA. So it's a way for you to create a tax-free income stream in your retirement. That's the difference between the traditional IRA and the Roth IRA. Now, because you've already paid taxes on your Roth IRA contributions up front, there are no required minimum distributions. So how much are you allowed to sock away on an annual basis? Currently, it's $6,000 a year. But if you're 50 years old or older, you can add an additional $1,000 for a total of $7,000 per year. There aren't income limitations. So if you're earning $1 million, you do not qualify to contribute to a Roth IRA. For 2022, if you are single and your modified adjusted gross income is $144,000 or less, you can start a Roth IRA. If you file married and your modified adjusted gross income is $214,000 or less, you qualify to open a Roth IRA. Now, if you haven't done so, you may want to take advantage of this wonderful gift the government has given us, because it may not be available in the future. Some people want to take advantage of a Roth IRA, and maybe they have money sitting in a 401k plan, or maybe a traditional IRA. They can do what is called a Roth conversion. They convert that account into a Roth IRA, but what happens is, well, they do have to pay the taxes when they do that conversion. So it's on an individual basis whether or not it makes sense to do so. And what I recommend is sitting down with your financial consultant to see what makes the most sense. For example, if you had $1 million sitting in a traditional IRA and you were seriously considering converting it to a Roth because you want to take advantage of the tax-free down the road, you wouldn't convert all of it at once because you'd get a huge tax bill. You'd do it a little at a time. So to summarize, the differences between a Roth IRA and a traditional IRA is with a Roth, you are building it and it's growing for you tax-free, as opposed to traditional IRA, you are deferring the taxes into the future. And we don't know what the tax rates are going to be in the future. They may be much higher than they are today. Retirement planning is complex, and it is not a DIY project, a do-it-yourself project. So if you have any questions, feel free to reach out to me at 561-302-5760. I'm more than happy to answer questions. My name is Sara Finkelstein, and I look forward to seeing you tomorrow. Have a great day.